Hi, good evening, everyone. Now, welcome to our Gold Futures webinar series. This webinar series is brought to you by Bursa Malaysia Derivatives and managed by our company Excellent. Now, our topic for today is a first look at the enhanced gold futures. I'm not quite sure whether you're aware or not, Bursa Malaysia Derivatives, they are going to relaunch this gold futures on 19th of September. That's the reason why we are organizing a series of workshops for you to understand this relaunched gold futures. Now, for today's session, we are going to have 90 minutes. First 75 minutes will be presented by both our speaker, Stephanie Lim and also David Ng, and we're going to follow by the last 15 minutes for Q&A question. Now, my name is Ting Ting. I'm your moderator for this session. Now, as usual, before we start, can you please just type in the chat box whether you can see my slides, you can hear my voice or not. If you can see my slides and you can hear my voice, can you please just type in the chat box, okay. So, okay. So I repeat, if you can see my slides, you can hear my voice, can you please just type in the chat box, okay. Or there's an emoticon, you can just click the thumbs up. Very good. I can see that many of you already answered that, so I assume that you can see my slides and you can hear my voice. So if you can't do that, you just need to follow these steps and you will be able to join the session. Now, as usual, please off your video because you are going to have a better learning environment. So please just off your video. I give you 1 second. Just click the video off. Then you just continue to enjoy the session. Now, along the session, it doesn't matter during our presentation by our presenter. If you have any question, you just need to click on the Q&A box and type in your question. You can send in the question in any languages like English, Malay, or even Mandarin. We're going to pick up your question and answer at the end of the session. So I repeat, you just need to click on Q&A box and just type in your question and send it to all co-hosts. Please do not sign in the chat box because you're going to see that chat box is going to be very fast. So we might not be able to pick up your question. So I remind you all, please just click on the Q&A box and type in your question. You do not need to wait until the end of the session. Along the way, you can just send in your question. Now, not only today's session, upcoming, we still have 2 sessions. One, we are going to organize in Mandarin, which is on next Monday, 12th of September. And we have another session on 15th of September, which is at next Thursday. We are going to organize in Malay. We are going to cover by different speaker, and you're going to see that, for example, next Monday, we're going to talk about 透彻黄金期货基本面是牛还是熊 and followed by next Thursday, we're going to have the pengenalan kepada peningkatan kontrak niaga hadapan emas. So you're going to see different topics. So if you are interested, you can just scan this QR code or in the chat box, there's a link. You can just click on the link and you can register accordingly because the topic might be different as well. Now, I'm not quite sure whether you're aware or not, Bursa Malaysia Derivatives is very friendly. They even give out this lucky draw. You just need to stay with us until the end of the session and you are going to have a chance to win this Touch and Go e-wallet worth 300 Ringgit Malaysia. So by the end of the session, we are going to let you know how can you participate via this session itself. Now, please allow me to introduce our first speaker for today. She's Stephanie Lim. She's currently attached with the Commodity Derivative Products Development Team at Bursa Malaysia Derivatives, and she's responsible for improving and expanding the commodity products offering of the exchange. Now, previously, she was a licensed futures brokers representative and moved on to the business development team with a regional investment bank for more than 10 years before joining Bursa Malaysia Derivatives. So without further ado, please allow me to pass it over to you, Stephanie. Okay, good to go.
Okay, I will start my presentation with the introduction of the revamped gold futures contract. First off, what is the revamped FGLD contract? It is the first quanto contract by BMD whereby it's a USD denominated gold futures contract that is settled in Ringgit Malaysia at a fixed multiplier of 40. Let's have a brief overview of the FGLD contract. As Malaysia's first precious metal futures contract, FGLD began trading on Bursa Malaysia on 7 October 2013. The contract was suspended on the 24th of March 2021 to undergo a revamp of the contract specifications. We're happy to announce that the revamped FGLD contract will be relaunched this month on the 19th of September. So the purpose of this revamp is to seize the opportunity to enhance FGLD's attractiveness for investors and at the same time elevating the foreign exchange fluctuations exposure between USD and Ringgit Malaysia. Let's take a look at the key changes made on the FGLD contract. So first off, the revamped contract, we have a contract multiplier of 40 per contract unit. So this multiplier of 40 derived from the estimated exchange rate between USD and Ringgit Malaysia, which is approximately 1 to 4. Contract size is changed from 100 gram to 1 contract unit, equivalent to the reference price per troy ounce times the contract multiplier of 40. The price will be quoted in USD per troy ounce instead of the previous Malaysian ringgit per gram. This is to align with the global convention where gold is traded in USD. As for the trading hour, the morning session will still be from 9 a.m. to 12:30 p.m. The afternoon session will be shortened from 2:30 p.m. to 5:30 p.m. instead of 6:30 p.m. There will be an additional of the after-hour T+1 night trading session, which will open from 9 p.m. to 11:30 p.m. from Monday to Thursday only. So gold is actively traded during the US and London trading session. Therefore, the availability of these night trading hours enable traders to access the market at these hours. The minimum price fluctuation for the FGLD is now USD 10 cents per contract unit. So this will be like with every tick movement of 10 cent USD, the fixed multiplier of 40 means that the value per tick movement is equivalent to 4 ringgit. The speculative position limit is reduced from 25,000 to 20,000. Okay, the daily price limit will be 10% plus another 10% to include the T+1 trading price limit. For the final settlement value, it will still be based on the LBMA gold price AM on the final trading day, rounded upward towards the nearest 0.1 value, which will be the reference price for the purpose of calculating the final settlement value. While we still rely on the price published by the LBMA, the fixed multiplier removes the requirement for a foreign exchange rate adjustment. So, as you can see here, this is the summarized FGLD contract specification. Besides the key changes that I mentioned earlier in the previous slides, the settlement method, contract months, and the final trading day remains the same. So for the full contract specs, please refer to your licensed futures broker. Okay, now let's take a look on how to calculate the profit and loss for your trades for this scenario. Let's say when gold price are expected to rise, you long one lot FGLD contract at, let's say, 1740.1, and later on you short and close your position at 1750.5. So how do you calculate your profit? It's simple. You take your selling price minus the buying price and multiplied by 40, which is the contract multiplier, which gives you a profit of 416 ringgit. Okay. Then the same calculation method will be applied on the bearish trade. So when the gold price are expected to fall, you short one lot at, let's say, 1760.5 and close your position at 1750. To calculate your profit, you take your selling price of 1760.5, then you minus it out to 1750 times the multiplier of 40, which gives you the profit of 420. So the whole P&L is not impacted by the USD MYR exchange rate. Throughout the entire fund flow from trading to clearing, domestic clients do not have to convert their ringgit to USD at all. Now let's take a look at how we calculate the final settlement price and final settlement value. Previously, we would need to get the LBMA Gold AM price fix, convert the currency, and you need to convert the unit measurement to calculate the settlement price. Now we only need the LBMA Gold AM fixed price and the contract multiplier. And for example here, the London Gold AM fixed price is at 1711.95. For the final settlement price, you will need to round it up to the nearest 0.1, which will be USD 1712. As for the final settlement value, take the final settlement price of 1712 times the multiplier of 40, which equals to 68,480 ringgit. Now, if you want to calculate the profit from your cash settlement, you will take 1712 minus 1696.9, let's say that's your entry price, and times it by 40, which will give you a profit of 604 ringgit. Okay. Who are the potential market players for the FGLD? They are gold bullion companies, commodity traders, and retail market. So this revamped FGLD contract will allow all the Malaysian investors to do so without worrying about fluctuation in currency rates due to there won't be any foreign exchange rate adjustment due to the multiplier. As you can see here, these are the list of approved collateral. While variation margin are in Ringgit Malaysia, initial margin are accepted in various currencies listed below, which is Ringgit Malaysia, US dollar, British pound, euro, Hong Kong dollar, Japan yen, Chinese renminbi, Singapore dollar, and Aussie dollar. So for full list of approved collaterals, you need to refer to your licensed futures broker.
Very good presentation about the contract specs. Now, just a tips for you as a participant. Now, along the way, while our speakers are presenting, you can just take note. And at the end of session, we are going to have a quiz session. So you need to answer some of the quiz questions to stand a chance to win the Touch and Go e-wallet worth 300 Ringgit Malaysia. Just pay your attention and try to answer the question. Now, please allow me to continue by introducing our second speaker, Mr. David Ng. He's a former head of marketing in Phillip Futures Sdn Bhd, and he's currently a full-time proprietary trader with Iceberg X Sdn Bhd, a local proprietary trading firm. So without further ado, let me welcome our second speaker for the day, Mr. David Ng.
Yeah, okay. Thank you very much. Yeah, thank you, Ting Ting, and thank you, Stephanie, for the wonderful introduction to the revamped FGLD contract. I think it's highly anticipated. After the previous FGLD contract, I think it's much needed certain revamp in certain areas. So I'd just like to thank Bursa Malaysia Derivatives as well as Excellent for inviting me to speak on this webinar. I think it's also timely for us to look at the gold market, or rather commodities in general. I think given that there's a lot of news flow that's happening in the market. So as a trader that is participating in the market, it is indeed a very interesting time, to be in the market, and to capture certain market opportunities that's present in the market. So just before I start, as usual, brief disclaimer. I think presentation here today is purely based on my personal opinion. It doesn't reflect the opinion by the exchange or by by the organizer as well. So it's purely based on my personal opinion. So any recommendations or any advice is purely based on my personal opinion. And dabbling with derivatives does involve risk. So make sure you do consult your licensed representative broker before you take your next action in the market. Now, I think just to kickstart the event with, I think Stephanie has done a very very thorough introduction to the revamp of the upcoming FGLD contract. So I will not touch in that respect. But what I'll cover in the next half an hour or so is to really look into what are the key factors that can actually affect gold prices. Now, being a trader, whether you are trading technically or fundamentally, I think both aspects of the market does play a role whenever you are looking at the market per se. So I'm just going to approach it in terms of looking at factors that can actually affect gold prices, particularly fundamental factors. So what drive gold prices? Now, I think the key question that when it comes to the gold market is, what we are seeing or what we have recently witnessed in the market is gold still remain very relevant when it comes to being a safe haven asset or instrument? I think whether its role still remain very prevalent or valid, I think that's much to be seen. But I think to a certain extent, historically, it does play a role. Historically, if you just look at based on past performance, gold does indeed play a very crucial role when it comes to being a very safe haven asset. Obviously, there's a lot of competing asset in terms of trying to get that role from gold. But nevertheless, I think history does show itself. I think gold remain very resilient when it comes to time of economic troubles. So, to a certain extent, I do personally believe that gold is still pretty much a safe haven instrument that's worth looking at for the medium to longer term. Now, there's a lot of factors that actually affect gold prices, but what we really need to know is that what are the key factors that actually drive gold prices. And obviously, I think last but not least, towards the end of the webinar session is probably we're going to be touching a little bit on technical aspect of the market, probably looking at how are we going to able to trade the market by looking at some technical indicators that is quite useful whenever we look at the gold market. So I think most of my presentation, or pretty much most of my presentation in the upcoming slides, are mainly centered on with reference to the COMEX gold market, for the simple fact that we have quite it is ultimately is going to be reference to pretty much the gold market as priced in US dollars. So I believe that having the COMEX as a good reference gauge as a way to reference with will be a good example to use with until the launch of this revamp of the FGLD contract, where we can get more data and obviously we can analyze the market thereafter. So with that, so do bear with me. I think most of my examples that have been shown here will purely be based on the COMEX gold futures market. As use it as a reference for some of my examples that I'll be explaining later. So do eventually when the product do launch, then probably we can look at it in a more thorough manner. But again, I think ultimately we are still looking at the gold fundamentals. It doesn't really matter whether we are using which market as a reference point, but really ultimately we really need to go down into what are the fundamentals that drive the gold market eventually. So these are some of the list of factors that actually affect gold prices. I think mainly you just look at the key factors is always with regards to the role of gold as a safe haven. So in times of economic troubles, crisis, or recessions, really gold is historically speaking, we have seen that in the past couple of decades, gold remain very relevant when it comes to economic troubles. Whether we are in right now in one, is still much to be seen, but I think it will remain very valid that gold can play a role when it comes to seeking shelter from economic troubles. So in times of economic crisis, a lot of fund flows will flow back into the gold market, especially in search of a safe haven. Now, besides economic crisis, I think inflation environment is also quite beneficial for gold in general. If you just look at the past couple of decades, if one can recall, later on I'm just going to show you on the chart. If you just look at 1970s, when in US where we have a very peak inflation numbers, we are seeing gold prices tend to perform very well during that time. Given that I think gold is not only as a safe haven asset, it also play a role as a store of value. So in a sense that I think when we have a high inflationary environment, normally gold tend to be favored. And in that sense, rather precious metal in that sense tend to be favored, especially when we are in a high inflationary environment. Now, US dollar index is quite tricky. Whenever you look at the strength of the US dollar, it does affect gold in certain ways. When you have a high US dollar, normally, gold prices will react quite negatively. That's what we are seeing right now. If you just look at the interplay of factors that's happening in the gold market right now, despite we are seeing a lot of sign that economy is slowing down, particularly in different parts of the world, by right, I think gold prices should gain a bit of support, but we don't see that. In fact, I think we see gold prices tend to be on the downside for a simple reasons that, you just look at US dollar, the strength of the US dollar itself. I think it's indeed, the strength of the US dollar is quite pivotal at this point in time, and is with the rising strength of the US dollar is actually putting a lot of pressure on gold market. So I think it's worth to watch if you are trading the space. The strength of the US dollar is something for us to really watch out for whenever you are trading the gold market. Now, besides that, gold is similar to the other commodities as well. Whenever we talk about commodities, it's always back to basic economics, whereby whenever you have a low supply, high demand, normally prices will rise. Gold in that sense is still remain very valid when we look at the supply and demand fundamentals. But what is crucial is that unlike other commodities, say for example palm oil, which is very sensitive, prices of palm oil is very sensitive to the level of supply or level of demand in a particular market. Gold in general, if you just look at the supply, it's actually quite fixed. You don't see a sudden a big increase in mining production for gold or recyclable supplies for gold. So rather, I would say the supply and demand dynamics for gold is actually quite neutral or quite balanced. But what's crucial is that the demand for gold tend to be a bit more volatile, for the simple fact that when economies are doing well, when people don't see any risk at all in the market, they don't like to favor gold. What they do is that they actually shift their portfolios away from the gold precious metal market and into the equities market. But then again, when economies are heading into signs of trouble, generally they tend to avoid the equities market and put some flows back into the precious metal space. So in that sense, demand for gold actually rises. Now, there's also other demand factors that actually affect gold prices. I think one particular will be jewelry demand. If you just look at, later on we will look at some of the stats. It's nevertheless, I think jewelry demand comprises quite a big bulk of the total gold demand. So if you really want to look at demand and supply dynamics, you must watch out on jewelry demand. Jewelry demand is actually down to two major countries, India and China. They love their gold, especially India. So really, if you want to look at whether demand is going to be strong, robust, just look at the demand for jewelry in India. Whenever the demand goes up, normally it tells you that demand for gold generally will go up. Now, last but not least, geopolitics is something that is unpredictable. As much as we want to predict the direction or trajectory of any particular scenario, that's very difficult to predict. So rising geopolitical tension usually is pretty much a good factor for people to be buying gold. Again, that we're probably looking at in times of trouble and crisis, a lot of people will actually rush into gold market as a way to protect themselves against any fluctuation in the equities market. So these are the few factors that we can look at, which is very key whenever you look at driving the gold prices. Now, in terms of performance wise, I think a lot of people say that gold tend to be a laggard performer as an asset class. Now, if you just look at this chart, it doesn't really tell you that picture of a laggard performer. If you look at it over the past decade or so, if you compare to other asset classes, I think gold generally performed quite well. If you just look at the average annual return for gold over the past 2 decades or so, you can clearly see that gold in general probably give you an average of about 8 to 10% on an annual basis. That's actually quite pretty decent. Obviously, you can't compare to equities market, which tend to see a bit more, bigger gains. But then again, bigger gains comes with bigger risk. So I think generally gold tend to be a very good store of value or very good asset class to hold in the longer run. Obviously, you look in the short run, there's a lot of price fluctuation, there's a lot of noises in the market. But over the longer period, I think if you look at it as a hedge of asset value, it does, in a way, does perform these roles quite well. Now, like I mentioned earlier, I think one of the key factors to look at in terms of demand is look at jewelry demand. So obviously, jewelry is a very big segment when it comes to breaking up the demand for gold. So jewelry, I mentioned, there's only 2 countries that's very large in terms of their consumption for gold jewelry. One is India and one is China. So when these 2 countries are not demanding much, normally we see prices tend to be softer because there's generally not enough demand for gold. But keep in mind, jewelry demand comprises probably about 30 to 40%. The major other bulk or other significant percentage is actually mainly to investment demand. Now, investment demand is pretty much down to the role of gold, whether it's in time of crisis, whether in times of geopolitical crisis. So in time like this, a lot of people will be very keen to go into the gold market. So therefore, it tend to push up prices. So we must take note that despite jewelry demand being a very significant factor when it comes to driving gold prices, investment flow or with investment demand is also another major player. Now, so if you just look at demand in general, despite we are seeing, jewelry having such a substantial amount, what is more crucial is that the investment and even in fact to a certain extent, the central bank's buying and purchasing of gold, in certain ways does affect the gold prices. So what we are seeing in the past at least 2 quarters, this is by World Gold Council. The past 2 quarters we start to see a bit of sluggishness when it comes to the gold market. Now, this is mainly attributed to a lot of factors. I think the 2 major factors is, first, we have rising interest rate. Rising interest rate is not only a phenomenon that is only in US, pretty much around the world is hiking their interest rate, except with the exception of China. So why is that bad for gold? Keep in mind, very simple. Gold as an asset class, it does not give you any dividend. It doesn't give you any interest. So it's a non-interest bearing asset. So in that regards, when you have a high interest rate environment, so your FDs will probably giving you a much better return. So people will not tend to go into the gold market when you have high interest rate environment. In fact, what they do is that they will sell their gold and park it in the higher interest rate yielding asset, probably like your FD or other instruments. So that's what we are seeing right now. We are seeing, a lot of major central banks around the world is in fact pushing or hiking the interest rate higher. So as a result, I think gold is probably suffering. Gold prices or gold demand is probably suffering because of that. So keep in mind, I think if you are trading the space, if you are trading gold market, World Gold Council is a very good website. It has a lot of data. If you're someone that love to look at data and charts, I think this is one of the important things to look at, especially when you want to assess the demand and supply for gold. Now, this chart is to show you the inflows and outflows of gold ETF. Technically speaking, if you are trading the gold market, these are some factors, several factors that we need to watch out pretty much on a monthly basis. If you just look at how outflows or inflows affect gold prices, you can clearly see whenever you have inflows into gold ETF, for pretty much you are quite safely can say that gold prices tend to move in tandem. So whenever you see gold prices goes up, normally you see inflows into the ETF market. And vice versa, if you see gold prices starts to come down, normally that tells you that a lot of flows are going out of the gold market. And partly, I think we need to understand, or we pretty much need to get a little bit understanding of what's the reasons that actually cause the outflows away from the gold market. That could be attributed to several reasons. So I think it's important for us to understand what those reasons are. Then in order for us to make a better judgment. So with that, I think it's easy to see. Right now, at least for the past couple months, we are seeing a lot of outflows. So therefore, I think prices of gold couldn't even reach the 1,800 mark, which is a very critical resistance, and it couldn't break that. And I think it's crucial to watch going forward. If outflows are continuing in this pace, I think it's worth to take note that I think gold prices would find it very difficult to make probably a short-term rally. So I think that's where we really need to gauge ourselves, especially when you look at outflows and inflows of gold ETF. Now, so that's pretty much on demand perspective. We just look at supply. Like I mentioned earlier, supply for gold is actually very fixed. There's always a fixed amount of gold that is, whether it's inland or whether it's offland, whether through recyclable gold. I think pretty much the supply is actually quite fixed. The surprising part is that, during the peak of the pandemic, we saw a drastic decline in terms of gold production. I think, in fact, a lot of miners didn't manage to actually go to mine, or pretty much a lot of miners actually were pretty stuck with the operation. So therefore, I think gold production was actually quite slow. But I think that has changed. A lot of countries now is actually moving out of the pandemic, moving into endemic phase. I think that's pretty much trying to pick up a bit of volume when it comes to gold production. But nevertheless, like I mentioned earlier, gold production is actually very balanced. You hardly see a very sharp increase in 1 year because there's only as much as gold supply you can have around the world. So again, if we want to look at prices, the dynamics of it, demand of gold tends to play a bigger role when it comes to driving prices. That's something that we really have to take note of, if you want to gauge the demand and supply dynamics for gold. Now, I think it's worth also to mention, this time I mentioned jewelry demand, investment demands are key demand factors. There's also another critical demand factor, which is central bank buying and selling of gold. Obviously, you look at some of the major advanced countries, their percentage of gold reserves is actually quite substantial. So obviously, I think, one of the key things that we really need to look at whenever you are, looking to trade, the gold market, always be aware of what are the sentiments or what's the factors that actually affect the demand for gold. So central banks is one of it. And currently, if you just look at it, at least the top 5 countries, US is actually the top in terms of their gold reserve, followed by Germany, Italy, and France. So the gold reserve is substantial. But what is important is that, surprisingly, if you just look at China, I think if 10 years ago, when I look back at this table, China was hardly in the top 10 or top 20 category. Over the decade, I think China has been rapidly upping their reserve in terms of gold. I mean, there's a lot of factors, or there's a lot of reasons for it. But do watch out. I think China purchasing so much of gold, there must be a reason to it. But I think right now, where it currently stands is that China is easily on the top 10, in terms of their gold reserve percentage among the world. So I think that's something that we have to take note of. And as long as China, being a very big player in the gold market, continue to ramp up their purchases for gold, I think that's in a way create a support for the market. But then again, there's a lot of other factors that's also impacting the gold prices, which will take a bigger role when it comes to the total effect, total impact on gold prices. Now, if you just look at this table, it goes to show that during time of economic turbulence, you can really see that gold tends to be a bit more favored as a asset classes. So I mentioned earlier in the beginning of my slide, when good times, people don't rush to gold, because in fact, people just rush into equities market. They tend to get a better return over there. Keeping in mind, equities market, you as an asset class, it gives you dividend. Gold doesn't give you any dividend or interest rate per se. So in a sense, it lacks that kind of appeal. And when good times, normally asset classes like equities market tend to perform very well. So therefore, I think a lot of people will not even look at the gold market. Now, things change when equities markets start to decline. When equities markets start to decline, people will start to look at alternatives. Where can they park, or where can they hedge their particular portfolio? So I think one of the good asset class to look at is actually gold. So if you just look at historically speaking, normally after any economic crisis, at least for the first 6 months, at the beginning or at the onset of the economic crisis, normally you see gold to outperform compared to other equity classes like the dollar index or even the equities market. In fact, it can last to a year. Now, after a year, it depends on how the market has performed. If you just look at all economic crises we have seen, at least for the past 2 or 3 decades, if you just factor in 1 year after the onset of the economic crisis, we can clearly see that the market generally will perform very well. So in fact, I think once economy is on its track, people will start shifting away from gold. But at least the first 6 months or even up to a year after the onset of any economic crisis, I think gold tend to perform very well based on historical basis. So I think that can give us or serve as a guide whenever we are looking into the next potential crisis that's in making. Now, so this table on the left shows you some of the key highlights or key economic highlights that we've seen over the past 2 or 3 decades or so. Again, you can clearly see that whenever US equities market doesn't perform, or in fact going into negative territory, gold tend to perform very well. So I think that's something for us to take note of. Whether we will see this pattern again, it remains much to be seen how gold can play an important role. Obviously, there's a lot of competition from other asset classes. The rising of the crypto market is also giving a bit of competition to gold, being as a only safe haven asset. So I think with all this in mind, it's important to understand what is the factor that's in play and which are the factors that will have a bigger impact. But historically speaking, in times of economic trouble, gold tend to perform better. So since 1970, since 1999, in fact early 2000, you can clearly see that really gold has performed much better compared to other asset classes. And in times of inflation, gold is also is the asset classes that actually is a good hedge against inflation environment. Now, in terms of looking at core relationship, so obviously I shown you the slide before. Whenever you have bad equities market, people rush to buy gold. So in a sense that gold is inversely related to equities performance. So if you're expecting equities to perform well, normally you don't expect gold to perform, and vice versa. But do take note, whenever we have now the fundamental flows in the market is slightly a bit more different, and the dynamics has changed slightly. In a way that once we see sell-off in equities market, normally we expect gold market tend to perform better, but in lately we don't see the kind of dynamics in play. That's again due to many reasons I highlighted in the beginning of the slide. So that is something that if you're trading a market, we have to watch out. As a trader, we tend to get a bit slack whenever you look at certain factors. You always tend to assume that based on historical speaking, whenever equities market don't perform, we kind of have a good comfortable level of predicting the market in gold will tend to perform better. But again, I think if you just look at recently, we don't see that as a case. So really, as a trader, we need to be very sensitive of what is the change or underlying dynamics in the market. But nevertheless, if history serves any guide, we can probably safely assume that if equities tend to be a bit more sluggish, gold possibly could be an asset that worth looking at as a way for you to hedge your equities market, or as a way to position your trade counter to a market downtrend. So that's something for us to take note of when you are looking at core relationship. Now, if you just look at gold and Dow Jones, at least for the past decade, you can clearly see we have a rising Dow Jones. January, I think gold market tend not to be favored. What's interesting is that back in 2020, at the onset of COVID-19 pandemic, we have a severe downturn in the equities market in the S&P 500. It was down more than 30%. The funny thing is that I think gold it went down as well, but after that it recovered pretty rapidly. So what goes to show you is that there's always a knee-jerk reaction in the market. When there's a sell-off, pretty much a sell-off across the board. But eventually, I think people will start to notice that we are actually in a health crisis. So people will tend to move away from equities market until they start to see the dust settle. So what they do is that they move out of the equities market and they move into the gold market. So with that, I think gold tend to benefit in that sense. Now, I think over the past 6 months or so, we saw a major performance in the equities market across the board. So I think generally, I think gold, although it hit as high as 2,000 US dollar per troy ounce, even I don't think it can gain back the kind of level again, unless crisis deepens. But it goes to show that when economic recovers rapidly, again the fund flow will be moving out of the gold market and back into the equities market. So in a way, it serves the purpose as an asset class, to really hedge against any economic turmoil or trouble, in a sense. So I think it still holds to a certain extent, but again, you must be sensitive to the dynamics that's in play. Like I mentioned earlier, the dynamics of the market can change rapidly. So being from a very risk-on market, you can suddenly turn into a risk-off market where everything gets a sell-off. So that's where we really need to be careful. So we cannot just rely on this historical relationship 100%, but I think we need to take it as a guide and position your trades accordingly. Now, that's equities with gold. If you just look at how gold perform in an inflationary environment, it's quite interesting. When you have low inflation, normally gold will not benefit much. But what's interesting is that when gold, when inflation starts to go above a certain level, so historically speaking, if you look at inflation level per se, I think anything that's above 5% is considered, pretty much a hyperinflation. So, but that's what we are seeing right now in US market. We start to see that inflation levels are actually above, 5%. So in those markets, generally gold will tend to perform well, because I think a lot of people will start to see that, when you have inflation environment, a lot of people will be moving out equities market and into the precious metal market. So in a sense, gold tend to benefit. And again, gold can be a very good store of value. If you just look at, prices of gold back in early 1980s to where it is right now, we can see a substantial increase in terms of gold prices. So again, I think inflationary environment or high inflation environment is quite beneficial for gold in general. So you are in an high inflation environment, and in a way, I think gold is also well supported because of the high inflationary environment they are seeing, whether it's in US or pretty much around the globe. So with that, I think that's also giving a bit of support in terms of gold prices. Now, if you just compare the inflation numbers against gold prices, this is as far back into 1980s. You can clearly see that when you have high inflation environment, you can see how supportive its gold prices is. So we have seen back in 1980s, where we have inflation numbers that skyrocketed, and in those period, I think price of gold also did rally. And again, I think we see that in 2008, that is a different scenario. That's not an inflation environment. That's more of a economic crisis. But right now, back in 2021 and 2022, we can clearly see that inflation start to pick up and gold prices tend to be supported. So that's interesting to watch. As long as inflation stays, above a certain level, in general price, I think gold tend to find a bit of support. Especially with this kind of environment. So I think based on historical relationship, this is something that we can fall back to, especially when you're looking into the gold market. Now, I would say a counterintuitive of inflation environment is obviously interest rate. I did mention earlier, whenever we have seen a high interest rate environment, normally it doesn't favor the gold market. And in fact, I think this is what we are looking at right now. We have seen high inflation numbers, and I think that's prompting a lot of central banks to actually increase their inflation level, interest rate level across the board. So I think the only exception of China, I think pretty much every central bank around the world is on the pressure of increasing interest rate. Now, as a way of fighting inflation, I think it's very common to see that high inflation environment obviously is good for gold market in general, but central banks are being prompted to actually hike interest rate to counter that inflation. So as a result, gold prices tend to not to be supported again, because gold is not an interest-bearing asset, in a way that gold is just an asset that doesn't pay you any interest. When you have high interest rate environment, normally people will start to look at other asset classes. So that's where it's very counterintuitive. So in a way that what we are looking at is whenever you have high interest rate environment, it's really going to be a negative factor for gold. And that's what we're clearly see right now in the past couple of months. Despite we are seeing, inflation numbers are high, but interest rate numbers are also higher. And that's usually a sign that people are rather putting their asset classes into other asset class besides gold. So that's something for us to be aware of, especially when looking to the gold market. Now, this is to show the interest rate relationship between interest rate and gold. So clearly you can see that when you have high interest rate environment, gold tend not to benefit. When you have low interest rate environment, normally it's quite beneficial for gold. So you can clearly see 2022 is the year where no longer we are in a low interest rate environment. In fact, we are in a high interest rate environment. So that's going to be a bit of pressure for gold market. So it's interesting to watch A lot of people are saying that, US interest rate is going to go at least to 3% or 4% to a certain extent. So that's going to be talking about another 100 basis point increase. So let's see how gold is going to be, performing in that sense. Clearly, that's going to be, strengthening the US dollar. Clearly, that's going to be bad for gold market, because as long as interest rate is going higher, there's no incentive to hold gold. So that's something for us to be worth watching at and to pay close attention to as well. Now, in terms of dollar and gold, you can clearly see this relationship here. Every time when we have a strong dollar, normally it's bad for gold. And because again, dollar itself is also serving as a asset instrument. And whenever you have high interest rate environment, you have strong dollar, normally people will not invest in gold. So this is a classic example of which fund flow will you be preferring to. So as long as dollar remains very strong, normally people will actually tend to favor dollar as an asset class rather than gold. So with rising interest rate, with stronger dollar, I think gold is definitely under pressure. That explains why over the past couple of months we're seeing a bit of weakness when it comes to the gold market, despite a lot of news that we are looking, we are watching on the flash. A lot of bad news is coming to the market. Possible recession in play. Manufacturing activities are slowing down. But then again, you still don't see gold prices tend to perform. So I think that explains why gold prices has actually been quite sluggish because of the rising dollar and the high interest rate environment. Now, this is basically to show you chart. The reason I put up this chart is just to show you the extensive or the range of how China is actually being supporting the gold market over the years. Like I mentioned earlier, I think over the past decade or so, China was hardly in the top list as the global central bank that maintained gold as a huge percentage of reserve. But China is slowly leaping into the top table. So it's worth watching. I think China has slowly become a dominant player in the market. But funny to see, I think surprisingly, over the past couple of months, China has been aggressively buying gold. I'm not sure what's the reason. Probably because I think eventually there's tension across different currencies. That could be a currency war in play. Once you have that, maybe China is thinking that gold could be a very good asset class to hold. So keep this in watch. I think is something to watch out, at least for the medium term to longer term. With China buying so much, I think it's going to be a good support for the market. Now, the reason I shared this, COMEX net position report, which is on weekly basis, as a way for us to indicate, what's the interest of the market, especially when it comes to the gold market. Now, if you look at COMEX Gold in US, on a weekly basis, they do publish on the net long and net short positions. Now, it's interesting to watch. If market participants in general are expecting gold market to perform, normally the net positions will tend to be more positive. That shows you that generally the prices of gold tend to be well supported. But if this net position starts to decline and in fact goes into net negative positions, which means that majority of the market is holding short, I think that tells you that generally the market may not see a rally, then in fact you may see a downtrend. So that's how we indicate the sentiment of the market or interest of the market. What's interesting to watch over the past couple of weeks, we have seen the net positions in the COMEX market has actually started to decline. In fact, it has shown slight negativity when it comes to net positions. So it goes to show whenever you start to see a declining interest in the open positions, that indicate that generally the market is not going to perform well. And true enough, I think the net positions we are seeing over the weeks has actually been declining. So it's interesting to watch whether are we going to see a net negative positions in gold market. If that's the case, I think generally, people are still expecting gold prices might have a bit more room to go down south. So that's how we're going to look at, or how we gauge the market sentiment through the open interest to the open interest positions in the COMEX market. Now, what I put here is also just to show the price seasonality of the COMEX gold market, at least for the past 12 years. What to take note is that you just notice that January and February usually are the periods where prices tend to be a bit more on the positive side. And if you just look at around July or rather September, October period, normally prices of gold tend not to perform well. in fact November as well. So what this tells you is that, you know, if you are someone that is trading based on seasonality patterns, you know, when you approach towards the third quarter, you tend to be slightly more cautious, because historically speaking, these are the periods where, you know, prices tend not to be well supported. But as you approach the January and February period, that's where you start to see prices tend to be well supported. Now, this is usually in line, you know, with your festivities. You know, Chinese Lunar New Year usually happens at the beginning of the year. Like I mentioned earlier on, China is a very big, player in the gold jewelry demand. So normally, beginning of the year, you have the Lunar New Year. Generally, their demand will increase. So that's explained why, you know, beginning of the year, normally you start to see gold prices tend to be a bit more positive. So that's how we look at seasonality. Again, these are all historical data. Whether historical will repeat itself is another question. So as a trader, we have to use it as a guide for us to, you know, to lay out what is a strategy and tool for us to use whenever we look into the gold market. So that's pretty much on the fundamental factors and aspect perspective of looking into the gold market. The factors I highlighted earlier, they are not exhaustive, but these are some of the several key factors that you know, one must look at whenever you look at the gold market. Obviously, there's also other external factors that's also having an impact in gold prices. You know, to whether to a lesser or greater extent, you know, it's still very much based on individual. But again, I think if you are trading the gold market, it's worth to pay close attention to those several factors which I just highlighted earlier on. Now, moving on to the technical part. Now, if there's many ways and many strategies to look at the gold market. Whether are you a trend trader or whether you are a trader that based on mean reversion techniques, it all depends on individual basis. For myself, I always tend to favor a bit more of trending strategies. So for me, it's very simple. As long as the market is having a trend, and you can identify the trend visually, I think that's a very good opportunity for you to take a position in the market. Now, there's a lot of ways for you to depict visually whether the market is in trending or not trending. One good way is to plot the chart itself with a 200 period EMA. So as long as prices are trading above the 200 period EMA, that means that the market is on the uptrend. And if the market is trading below the 200 period EMA, that tells you the market is on the downtrend. So if you just look at this chart here, this is on COMEX Gold. You can clearly see that prices are now trading below the 200 period EMA. In fact, it started to trade below 200 period EMA back as early June this year. And in fact, now the market is still pretty much on a downtrend. And it has to clear the 1800. If it doesn't clear the 1800, the market is still on a downtrend basis. If it does clear the 1800, which is a very strong resistance, that tells you the market is going to be on an uptrend. So that's how you differentiate whether a market is trending upwards or sideways or even downwards market. So I always emphasize this in most of my webinars. If you are trading the market, trade with the trend. If the trend is showing you upward potential, find position for you, find opportunities for you to long the market. Don't be brave enough to find opportunities to short in an uptrend. Trust me, it's not an easy proposition to do. So this is something for us to take note. If you're a trend trader, trade with the trend. Now, if you just look at this example here also, I also put in another relationship example between crude oil and gold. Both of them are commodities. But what's interesting to watch is that recently the relationship between crude oil and gold has actually heightened quite a lot. In fact, if you want to look at commodities in general, just look at performance of crude oil and gold. Whenever crude oil starts to come down, normally you can expect gold prices starts to come down as well. So whether is there any basis or relationship between these two, it's hard to determine, but both of these asset classes are commodities in general. So really, I think it's interesting to watch. Whether can be based on using crude oil to trade gold, I wouldn't recommend that, because crude oil, again, is a totally different product by its own. But the relationship between prices are quite interesting to watch, because these two particular products is displaying a bit of certain tendencies when it comes to prices. Now, India, the reason I put up this chart is because just to show you that India is also a very big player in terms of their jewelry demand. And again, just look at China and India. As long as they are buying more, they are importing more of gold, generally they are giving they're giving strong support for the gold market. Now what I have here is that to compare gold against VIX index. Now, a lot of people will say whenever VIX is an actual barometer to indicate fear in the market. When you have high VIX index, that tells you generally there's fear in the market. So when you have huge fear in the market, normally your VIX index usually spike up. And when you have VIX index spiking up, that means a lot of people will be fearful of the market and they rush into gold. So clearly you can see VIX index now have moderated. Back in 2020, obviously, VIX index just spiked up tremendously. But then again, that has changed. I think right now you clearly see that, VIX index has started to normalize. But crucially, I think the past couple of days, VIX index start to perform a bit, it starts to inch higher. That tells you generally the market is starting to be a bit more fearful. And that's where if you're watching the gold market, it is worth to pay a bit more attention to as well. Now, so going back into the technical perspective, so once you identify the trend, it's good for us to, as a trend trader, we use other indicators for us to determine whether the market is trending upwards or downwards. So besides looking at using the 200 period EMA, one can always use the Heikin-Ashi dynamics. Now, for those who are not familiar with Heikin-Ashi, it is very similar to Japanese candlesticks. In fact, it's actually derived from Japanese candlesticks. Now, it's slightly different from normal Japanese candlestick in the sense that, in Japanese candlesticks, there's so many configurations. You have to know whether it's a doji or a harami pattern. There's so many patterns, 100 patterns. You can get it all across the web. So it's very difficult to identify if you use a normal Japanese candlesticks. The reason I use Heikin-Ashi is in a sense that it's easier. When you look at trends, Heikin-Ashi does tells you whether the market is trending upwards or downwards in a much clearer manner. In fact, Heikin-Ashi has only 3 basic distinct patterns. As long as you see that you have to see a candle, green or red, with both tails or wicks, usually that tells you market strength is actually declining. So if you are looking at a trend, if you are having a position in the market, that usually be a candle that tell you to get out of the market. As if you see a candle with only an upper wick or lower wick, and red or green, that tells you generally the momentum is there. So the trend is still in place. And if you see a small body but long wicks, like a doji type of pattern, that tells you generally the market has no trend. It's quite directionless. So there's only these 3 distinct patterns that you need to know whenever you use Heikin-Ashi. So just to put it into dynamics, you can clearly see here. This is on the daily chart basis on COMEX Gold. Whenever you see a green candle bar on a Heikin-Ashi, in a sense that it's telling you that the market is going to trend upwards. Now, if you just look at this and you compare to a normal Japanese candlesticks, the biggest difference is that you don't see any gaps. The gaps are being covered by the candle. Now, if you are trading based on gap strategies, I wouldn't recommend Heikin-Ashi. Heikin-Ashi is if you are using gap as a trading strategy, you can't get anything if you use Heikin-Ashi. So Heikin-Ashi is purely based on looking at the trends, whether the strength of the trend is there. So one way of looking at it is as long as the green candles are forming, that generally tells you the market is trending upwards. Vice versa, if the candles as red candles appear and is getting longer and longer, that generally tells you that the market is heading on a downtrend. So Heikin-Ashi is a very good example for you to look at whenever you look at a particular trend on the market at a particular point in time. Now, besides using Heikin-Ashi, to make it more effective in terms of your entry and exit strategies is to apply it together with moving average crossovers. So moving average crossovers are simple. Normally you have a 2 period. One will be the shorter term, one will be a longer term. Now, in my example here, I use a 9 period EMA and a 20 period EMA. So the 9 period in the sense that is a shorter term period, and the 20 period EMA is a longer term period. So crossovers are quite simple in a sense, in a way that whenever you have a shorter term crossing below the longer term, which we term as bearish crossover, so that tells you generally the market is going to be on a downtrend. So in that sense, we have if you see a red Heikin-Ashi bars with a bearish crossover on your EMAs, that will be a very good position for you to take an entry to short the market. vice versa, if you see a bullish crossovers on EMAs together with the green Heiken Ashi bars, that will be a very good position for you to long the market. Now, last but not least, in every technical setups and strategies is that you need to make sure you have a stop loss strategy in place. There's a lot of ways for you to put stop loss measures. I'm not going to go too much in detail in that section, but one of the key things that you can use to measure your stop loss is to use what we call an ATR indicator, average true range for short. In a sense that this indicator measures the true range of the market in a particular point in time. So do notice that, COMEX in general on a daily basis, it record about 20 to 30 US dollar points price difference. That's actually quite substantial. So if you look at it, I think back in 2020, we saw, the daily range went up to as high as 70 US dollar on a daily basis. Again, that's also very volatile. Normally as a trader, we love volatility, but with every type of volatility, we always make sure that the risks that we are exposed to are also measured and controlled. So ATR, in a sense that this is a very good tool for you to apply stop loss strategy, in the sense that if you see the ATR value, example here is about 30 US dollar on a daily basis. So if you are thinking to short the market because you see the red Heiken Ashi bars and there's a bearish crossovers on EMAs, so technically you'll be applying 30 US dollar as your profit and loss potential. So that's where we start to see how we use ATR as a way to measure your risk. Do make sure whichever setup that you're using, you must have a stop loss strategy in place. So I think ATR is a good place to start off with. If you're not sure how to apply stop loss, you can use the ATR value. So make sure if you are shorting the market, let's say you are shorting at 1700, and the ATR value is 30 US dollar, make sure that you put a 1730 as a stop loss point. If you want to work you want to multiply the ATR, you want to have a bigger stop loss, you can obviously do that. Keep in mind, if the market goes a bit more volatile, that tells you that the market in general is going to be a bit more volatile. So you must prepare to accept a bigger risk, and in terms of accepting loss potential. So that's where you can say is a disadvantage of using ATR, but it helps you from getting a bit more whipsaw action, where you tend to place stop losses that you can get a lot of whipsaws. You'll be exiting the market pretty common. So I think ATR will try to prevent that. But the downside is whenever market gets a bit more volatile, that's where you need to be more acceptable to accept a bigger loss, because that's the risk that you're being exposed to, especially when markets gets a bit more, the ranges get a bit more wider. So I think on my end part, the last part of my webinar, I think it's quite clear enough. It's very evident, regardless the economic conditions we are in, and in light of what we are seeing in the market, I think gold has a lot of potential, whether being as an asset class that preserve its value during times of crisis. I think it's quite evident that we are heading into that kind of trajectory. So in the longer run, I think gold has potential in the sense that it's a good asset class to have to gain exposure with. Now, relating back into FGLD, the revamp product of the FGLD. Given the fact that we don't have to although it's quoted in US dollar but settled in ringgit, in a way we are not exposed to the ringgit to US dollar exposure, in a sense that we still can gain exposure in the gold market, but at lesser risk. You don't face that kind of exchange rate fluctuation. So I think it's a very good potential for you to be looking at the market. If you want to gain exposure in the gold market, it's a good place to start off with the FGLD contract. Now, whether the role of gold as a safe haven instrument is still remain pretty much to be seen. But historically speaking, in times of trouble, in times of crisis, I think that's normally a good time for you to be looking at the gold market. Now, relationship with external markets. If you just look at crude oil, for example, I think recently, we've seen a lot of positive relationship in the commodity space. Whenever you see negative movement in crude oil prices, we start to see the same for gold market. So that's where I think external market has a bit of relevance if you are trading the gold market. Do watch out. I'm not saying that you can trade gold based on crude oil performance itself. I'm not saying that, but have a look at it. I think it's interesting to watch. If there's sell down in commodities, I think Jenny, gold will also be impacted by that. But in the medium to longer run, I think gold still remain quite potential in the sense that of its role, whether it's a safe haven asset or whether as a role to preserve, especially against inflationary environment. So with that, I'm just going to end it here.